There are three key time frames traders use, each serving its own role: the analysis time frame, the higher time frame, and the entry time frame. In this video, we'll dive into multi-timeframe trading and how blending these charts can lead to smarter trading decisions. If that's something you're into, go ahead and tap the like button to show some support and subscribe to the channel if you're new. Catch you right after the intro and disclaimer. As mentioned earlier, we focus on three time frames: the higher time frame, the analysis time frame, and the entry time frame. Based on their trading approach, traders mix and match time frames that align with these categories. For instance, scalpers might rely on 15-minute, 5-minute, and 1-minute charts to time their entries. In contrast, day traders and session traders often refer to higher time frames to study market behavior and plan their trades. Each of these time frames serves a unique purpose, which we'll explore further. We start our analysis with the analysis time frame, where the goal is to determine the current market direction. The first step is to assess who has control, buyers or sellers. Are we looking at an uptrend, a downtrend, or a sideways market? Once the direction is clear, the next move is to shift to a higher time frame to assess the possible longevity of the trend and spot key reversal zones for the short-term move. Using both of these time frames together gives us a clearer picture of market structure. The final step involves switching to the entry time frame to look for confirmation signals and place the trade. To recap, we first identify the market trend using the analysis time frame, then check how far the move can go before hitting reversal zones, and finally, execute trades on the lower time frame. When we start our chart analysis, the first step is to outline the market structure schematic in order to determine the market direction. The main goal of drawing this schematic is to examine recent price movements on the line chart, helping us understand who holds control and identify key structural levels. Let's say these are the latest market movements on the 1-hour chart, which serves as our analysis time frame. Any reaction to a specific price point is considered part of the market structure. However, the strength of these moves is defined by the imbalance. For instance, if we spot a fair value gap within the recent impulsive move, this area could serve as a potential supply zone for a short trade, in line with the dominant downtrend. These concepts are essential when working within the analysis time frame. So far, we've identified the market direction, key levels, imbalances, and a potential short opportunity. But let's imagine our higher time frame structure looks like this. It indicates a general uptrend, and the price has recently rejected a key demand zone. This area could act as a turning point for the short-term downtrend, suggesting the price might continue upward in alignment with the higher time frame trend. With this context, placing sell orders on the 1-hour supply zone becomes risky. The higher time frame levels hold significant weight, and this demand zone could drive the price higher. As the price approaches the supply zone, there will be a battle between buyers and sellers. If buyers prevail and break through this area, we can confidently conclude that the short-term downtrend has ended, and the price may push higher. Now, with both the higher and lower time frame aligned, we can confidently proceed with our analysis in the analysis time frame. Now, that brings us to an important question. In this exact scenario, under what circumstances would it be valid to place sell orders at this supply zone? We can only consider setting sell orders if the higher time frame bias is clearly bearish. If we observe a break and close below this region on the higher time frame, it signals that buyers have lost control, marking a shift in market structure. In that case, this supply area turns into a valid shorting opportunity. A sell limit can be placed at this zone, anticipating that price will reject downward. For a more cautious and secure entry, it's wise to wait for confirmation on the entry time frame, which should be lower than the analysis chart. Spotting confirmation on the entry time frame can offer a more precise entry point and an improved risk-to-reward ratio. Still, it's worth noting that this can also lead to misleading signals before the actual move occurs, given how unpredictable the market can be. This supply zone does offer a strong short setup in line with the current downtrend, but an exact rejection from this specific box isn't a certainty. The market may react to various supply levels within this broader range. Each of these supply areas presents a valid opportunity, provided it aligns with your trading rules. If you're unable to determine which specific zone holds a stronger probability of rejecting price, and multiple zones meet your trade criteria, One effective method is to place several entries across those levels, each with smaller risk exposure. In many situations, there isn't a definitive reason why the market reacts to the first or second zone, or it may bypass both entirely and continue climbing. Trading is a game rooted in probabilities. While we can't influence the result of an individual trade, we can manage the outcomes across a series of trades by following a solid risk management strategy. This is precisely why having a risk plan in place is essential. It has a direct impact on your long-term trading performance. When operating on lower time frames, your entry setups can consist of different price action cues, ranging from a basic engulfing candlestick formation to more complex smart money concepts like a liquidity sweep. Any of these can serve as a valid reason to enter a trade. What truly matters is that you thoroughly backtest your entry strategies before applying them in a live environment with real capital. Let's quickly summarize before we dive into actual chart examples. Our chart analysis starts with the analysis time frame. This is where we typically apply the bulk of smart money concepts. The first task is identifying the market direction by drawing a line chart that follows the most obvious swing points. In general, high probability trades tend to happen when the market direction is clearly defined. After establishing direction, we focus on identifying fair value gaps, supply and demand zones, and liquidity levels. Once all these elements are marked on the chart, we should have a clear directional bias and a defined area of interest for potential trades. If none of these align or make sense, it's better to move on and analyze a different trading instrument. Now that we've completed the checklist for the analysis time frame, it's time to zoom out and examine the higher time frame to confirm whether our lower time frame outlook matches the broader market context. There are two core concepts we focus on at this stage of the chart analysis. First, we aim to establish a directional bias for price movement on this larger scale. Second, we identify major higher time frame support and resistance levels. These higher time frame levels are critically important, as even a minor price reaction at these zones can indicate a significant trend shift within the lower time frame. With the higher time frame checklist complete, the next move is to zoom into the entry time frame and seek confirmation if necessary. At this stage, we wait for the price to reach our marked trading zone before executing a position. Although trades can be taken from either the analysis or entry time frames, a more conservative approach is to switch to a time frame that's at least half the length and search for an entry trigger. This trigger could be a directional shift that signals a possible reversal, giving us insight into the market's next potential move. Alternatively, chart formations such as double tops or double bottoms can serve as precise entry points within this lower time frame. Now let's take a look at the EUR15 United States dollars minute chart. Recent movements indicate an upward trend, but the price has encountered a resistance level it hasn't managed to break. Beneath, there's a support zone that has repeatedly held the price from falling further. This suggests the market is currently consolidating within a defined range. With our directional bias set to bullish, our focus remains on buy setups for this currency pair. As a price action trader, there are two potential trade setups. The first approach is to wait for a pullback to the support zone, enter a buy trade, and target the resistance level. Alternatively, we could wait for a breakout above the resistance, then anticipate a retracement back to the former resistance, now turn support, and go long again. Switching to the smart money perspective, we can spot two clear liquidity zones. When price nears the support area, traders tend to buy and place their stop losses just beneath, forming sell-side liquidity. Similarly, at the resistance, short sellers set stops just above, creating buy-side liquidity. Given our bullish bias, an ideal trade would involve the price clearing out the sell-side liquidity, then reacting from a demand zone to confirm a long entry. Our take-profit target in this case would be the buy-side liquidity. The rejection candle with a long wick suggests a possible demand area, ideal for upward momentum. Zooming into even lower time frames may reveal fair value gaps inside this zone. For now, these are the core concepts used within our 15-minute analysis time frame. The next step is to zoom out to a higher time frame and evaluate how this analysis aligns with the broader market context. Now, shifting our focus to the 1-hour chart, we can observe that the price had been in a prolonged downtrend. However, after reaching a key support level, the market failed to push lower despite multiple attempts. Instead, it began forming a clear structure of higher highs and higher lows, a classic indication of a bullish reversal on this higher time frame. With both the 1-hour and 15-minute charts reflecting a bullish trend, this alignment strengthens our directional bias. If we decide to enter a long position, the ideal target on the 1-hour chart would be the most recent significant turning point, where previous bearish momentum began to shift. Now, let's return to the 15-minute chart. At this stage, our goal is to wait for the price to dip below the current support level. This move is likely to trigger liquidity, clearing out stop losses from long positions, and potentially reveal a fresh demand zone. This is where we'll be looking for a buying opportunity. To fine-tune our entry, we'll now zoom into a lower time frame, our designated entry time frame, to closely monitor price action and look for confirmation signals that align with our trading plan. On the 5-minute chart, we can spot several small fair value gaps on the left side. These represent potential demand zones where we anticipate the price may bounce. One aggressive strategy would be to place a buy order directly within this zone, with a stop loss just below the range. However, for a more cautious approach, it's better to wait for confirmation, a clear signal that buyers are stepping back in. Currently, we're seeing strong selling pressure, and the latest price action has created a bearish imbalance. This suggests that sellers are still in control. If the price pulls back to this area, the order block could serve as a short-term supply zone, potentially triggering a downward rejection. However, if the price breaks above this level, it would indicate a shift in momentum, a signal that sellers may be losing control, and a bullish reversal could be underway. This would change our bias to bullish on the 5-minute chart, giving us more confidence to enter a long trade. Notably, price has now returned to the range, suggesting the earlier drop was likely a liquidity sweep below the equal lows, a classic fake out. With this in mind, we can consider entering a long position, placing our stop just below the fair value gaps. This example shows how using multiple time frames and analyzing price behavior across them can lead to well-informed trade decisions. But remember, knowing when not to trade is just as important as knowing when to enter. That's it for now. Thanks for watching this video. If you're interested in diving deeper into our trade entry strategies, make sure to subscribe to the channel so you don't miss future updates. If you found value in this video, please give it a thumbs up. It really helps us continue producing high-quality content for traders like you. Have questions, feedback, or topic suggestions? Drop them in the comments below. We'd love to hear from you. Thanks again for watching, and I'll catch you in the next episode. Stay sharp and trade smart.